Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Black Friday is certainly underway. We got a great live blog on the Bloomberg terminal that's following reporters who are all over the country. Check it out because they're dispatched, checking out the crowd, seeing what people are buying. Vonnie, a lot of people apparently in line to get the Taylor Swift book at Target. Did you hear about this?
I'm loving this blog because we're just talking to people all over the country at these malls of paradise and malls of America and all these different malls. And it's really fascinating. And yes, Taylor Swift merchandise is some of the best selling. But I saw it today. I was down at Macy's and I saw massive crowds coming in by 10 o'clock. And I think the weather had a lot to do with it, Tim. So at 6 o'clock, there weren't too many people around. It was 29 degrees.
6 a.m.
6 a.m. when Macy's opened in Herald Square. But by 10 a.m. when it was a little bit warmer and, you know, there was no rain. Everyone had been stuck indoors on Thanksgiving because there was so much rain in the tri-state area, at least. People were out. They wanted to see what else. What are the discounts? What's available?
What did it seem like there were discounts?
It seemed like there were massive amounts of discounts. Everything was 40% off or everything was 50% off. But I have to say, one comment from our live blog really did strike me. This man that we spoke to, Jonathan Overton from DC, said, I don't really know what sales are going on, to be honest. There's not really a lot of signage. No one's really telling you what's happening. And I did feel a little bit like that because it was a bunch of merchandise and then, you know, at the side, a sign with 40% off and some small writing underneath. And it wasn't quite clear whether this was 40% off the sale price or the full price or, you know, sort of a little bit of a grab bag. You get to the counter and you figure out what you're going to owe. Okay,
so we got the great anecdotes from 34th Street, where you were at Macy's, and from all over the country over on the live blog. We also want to get an idea for what data folks are seeing out there. For that, let's bring in Julie Van Ullen. She's Rakuten Rewards Chief Revenue Officer. It's a cashback shopping platform. It's a subsidiary of the internet services giant Rakuten Group. Good to have you with us, Julie. Just give people an idea of the insight that you have with this tool, because you know, if you're shopping online, you know about how you can use this tool, but just give people some insight into the real-time data that you get over at Rakuten.
Yeah, I'm happy to do that, and thanks for having me on this glorious Black Friday. Rakuten is a massive shopping platform with the best rewards out there, especially this time of year, but all year round, where we have about 5,000 brands who are working with us in order to attract the best shopping possible by offering rewards by way of cash back that are stackable on top of the amazing deals and promotions that are happening during big promotional periods like this. It's entirely free for consumers to join. We have about 17 million consumers today and growing.
And where are these consumers, Julie? Because obviously, you know, we're looking today particularly at the US consumer, but Rakuten would have tentacles around the world, right?
We do. However, the business that we're discussing today and the data the rich data that we'll talk about in terms of what we're seeing from a consumer behavior standpoint is really a North American business, Rakuten Rewards.
So you say 17 million consumers sign up, and roughly on average, you know, in a year, what kind of reward would a consumer expect to get?
Oh, it's entirely dependent on the shopper, right? It's a rewards platform that rewards a consumer for frequency and for average order value, right? So the more you buy, the more likelihood it is that the brands that you love the most are going to be paying attention to that and giving you more rewards to come back more frequently. So it really is engendering loyalty and frequency, and that's how the brands and retailers view us differently than what they can do on their own with their own base of shoppers.
So we're already starting, you know, we're in the midst of the holiday shopping season, Julie, and we're already starting, even in recent months, to get some of those consultant reports out with how much they think consumers are going to spend. We talked about a Deloitte report out earlier this week that said that over the holiday period, and especially today, between today and Cyber Monday, consumers are expected to spend 15% more than they spent last year, $650. So a new record there. What are you projecting over at Rakuten?
It's been a really interesting year so far. I think that we are also projecting what would be a record year, both online and also growing in-store sales. But I think that a lot of the data that we've been showing up until now over the past couple of weeks, as well as in yesterday and even this morning, speaks to a couple of really interesting trends that are specific to this year. The first one I would say is around consumer intent, that we see consumers browsing less, but shopping more. So we see on our platform sales are up, average order value is up, but browsing is a little lower. So I think that that speaks to perhaps the very intelligent consumer doing their research, making their list, checking it twice, and making sure that they are ready to pull the trigger when they see the best possible value, whether that value is by way of promotional discounts, cash back, free shipping, whatever it is, they're ready to go. And in tandem with that, I think it's also been a very buy now moment since the week after the election, which is to say that we saw a 57% increase in shopping the week after the election versus the week before. And that has continued where there's been a record amount of early shopping happening. So I think that, again, speaks to the consumer sentiment, perhaps the turbulence from an economic standpoint, and them wanting to ensure that they get in now when they feel comfortable that they've gotten the offer that's good enough for them.
Julie, you say you have a mound of rich data, and I'm just curious, who is the Rakuten Rewards signer-upper? So there's so many rewards programs out there now, and no matter where you shop, it seems like you're invited to be part of the loyalty program. What would the niche sort of offering of Rakuten Rewards be that would make me want to sign up for yet another program?
I think the really interesting part about what we do is that it runs the gamut of categories. So we aren't even just focused on traditional retail categories. We yes, certainly have the apparel, health, and beauty categories that folks are so interested in buying this time of year, consumer electronics, but also verticals like travel, like consumer banking and financial products. So given the fact that it's a one-stop shop for being able to kind of weigh the value of what brands are willing to deliver across categories, it's particularly fascinating to consumers in a way that spans the gamut that a singular rewards platform might not be able to do.
Julie, what do you get out of the Rakuten Rewards program in the sense as a company? You have to entice people to use it. Do you get paid by the retailer, or is the data so powerful that you can then make money selling it?
That's a great question, and it's a very simple model. We are highly protective of consumer data, and we are in no way, shape, or form interested in using it for monetization. The model is entirely an advertising model whereby all of the brands and retailers with whom we work see our platform as a way to get access to shoppers who will shop more frequently and buy more when they get that cash back, which is effectively the permission to buy that they need. And when they give us those advertising dollars, just like any media platform that would get advertising dollars, we simply pass about half of those dollars back to the shopper in the form of cash back.
So we were talking earlier about the amount that somebody spends then dictating how much they get back in rewards. But you must have an average figure or even a mean figure for the Rakuten Rewards devotee, let's say.
It's a very tough one, I'm afraid. But certainly what I think it speaks to is the fact that it varies year by year and person by person. I did want to mention one more trend to you guys, which is super interesting this year, which is that we're seeing still to this moment, as we're monitoring real-time data, that there's this fascinating trend happening where it's a first me, then you season. And by that I mean shoppers seem to be shopping categories that are much less traditional giftable categories. They're very interested in areas like pet care, financial services, health and wellness, particularly CVS, Walgreens. So what we see is people out there, again, probably because of concerns around potential economic trends, they're saying to themselves, I need to get myself shored up with these deals and my family shored up first before I move ahead to think about gifting. We do predict that that's likely to change, shift over a little bit later today, especially as we go into the weekend and Cyber Monday. But it's a particularly interesting trend of consumers interested in using this moment of very high promotional, free shipping, cash back, stackability to do what's right for them and their family first.
Julie, one thing we talk about a lot is what retailers who are traditional brick and mortar retailers have to do to get consumers in the door, given that it's so easy to buy so much of this stuff online. What's the message that you have based on the data that you see, what consumers are doing online, to retailers who are trying to figure out this omni-channel approach?
It's a great question. Part of our business is an in-store capability whereby when a consumer links their credit card on our site, then you're able to achieve the same level of cash back that you might get online going in store when you use that credit card, and it just automatically happens. And that part of our business has grown dramatically year over year. And to answer your question, I think the reality is that we are dealing with a very value-seeking consumer who isn't just content with discounts and prices that a brick and mortar might be able to offer even during a time like Black Friday. They need to know that they're getting more. So a lever like cash back enables these retailers to offer something more that gives the consumer a permission to buy. What I will also say about retailers and brands is that there is certainly, and this is more just holistically as an omni-channel event, is that there is a democratization around where brands can be purchased by consumers. And by that, I mean, retailers are in a way starting to compete with the direct-to-consumer brands themselves that they sell in their stores, because those brands may be able to offer higher cash back, but they may have a lever to do things like free shipping with the larger infrastructure that they have. So it really is about figuring out what levers do you have and using them.
All right, Julie, let's leave it there. That's Julie Van Ullen, Rakuten Rewards Chief Revenue Officer, joining us on this Black Friday. Julie, thanks so much for taking the time. Always good to check in with you.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
President-elect Donald Trump had dinner with Meta CEO Mark Zuckerberg at his Mar-a-Lago estate on Wednesday. Zuckerberg meeting with Trump and members of his team as the president-elect prepares to return to the White House in just 52 days now. For more, we're joined by Bloomberg's Kurt Wagner. Kurt, do we know anything about the conversation? I know representatives for Zuckerberg did let out a few little comments.
They did. They were very vague. They said, that it was an important time for innovation, which is one of the things that they want to talk about. I think we can extrapolate from that a little bit to assume that they probably touched on AI, because this is something that's been a key priority for Meta over the past year and a half. They're investing very, very aggressively in all types of AI products and features. And as you can imagine, there's a lot of concern about what the incoming administration might do in terms of regulation with AI. So I do think that hint about innovation to me is a sign that AI was probably at least one of the many topics of conversation at that dinner.
Maybe I'm a cynic, but my takeaway, Kurt, and you know this better than I do, was not that at all. I mean, my first reaction was like, Mark Zuckerberg's got to get on the Trump administration's good side, given what we've heard on the campaign trail. Now that Elon Musk is there nonstop, and we know that Elon doesn't have a great relationship with Mark Zuckerberg. These guys are like nemesis. I mean, am I too cynical here?
No, I definitely feel like there's a little bit of damage control being done here, right? And it's not just from the last couple months. I mean, remember 2 years ago, or I guess more than 2 years ago at this point, Donald Trump was suspended from Facebook and Instagram for 2 years, right? And that created a huge issue. Since then, when he was on the campaign trail, he talked about, wanting to keep TikTok around simply because he knew if TikTok was gone, it would help Facebook. He even insinuated that he might want to try to put Mark Zuckerberg in jail, right? That was just a few months ago. And so we've seen Mark Zuckerberg sort of in the last couple months since this summer, really, say flattering things about Donald Trump. He called the president-elect before he was elected back in the fall. Now he's showing up at Mar-a-Lago for dinner. I think your instinct is pretty spot on, which is that this has been a tumultuous relationship for several years now. And it's certainly in Mark Zuckerberg's best interest to make sure that Donald Trump, at the very least, thinks of him as neutral, right? So that he's not coming after him and attacking his businesses.
For sure. And he did make a comment after the assassination attempt, the first one, saying seeing Donald Trump get up after getting shot in the face and pump his fist in the air with the American flag is one of the most badass things I've ever seen in my life. So he has been quite, complimentary of the president-elect. What could the president-elect do, though, just in terms of the company, not Zuckerberg personally? He can blacklist him from Mar-a-Lago. He can do whatever he wants to Zuckerberg personally. But he would need someone like Alina Khan on board to actually hurt the company, no?
I think so. Well, it sort of depends on what you describe by hurt or what you mean by hurt, right? I think what we saw after the 2016 election was that Facebook really got bogged down with all of these claims of Russian interference and Mark Zuckerberg being summoned to DC every year to answer these questions. It's just a lot of distractions, right? I feel like that's the kind of world that Donald Trump and Congress could create for Mark Zuckerberg. They could just make his life much less enjoyable. Now, on top of that, as you guys mentioned, Elon Musk is in the picture, right? And Elon and Mark Zuckerberg are not friends. They have a very healthy rivalry. And so, now you have the president's sort of top advisor who's an anti-Facebook guy. And so I do think that there's this, potential threat that the administration could simply make Mark Zuckerberg's path these next 4 years very difficult if they want to. And so that's, again, why you see him showing up to have dinner the night before Thanksgiving.
Kurt, there's this idea, and we saw this actually play out a few months ago in the vice presidential candidate debate with J.D. Vance talking about censorship on social media platforms, and this idea of this anti-conservative bias. And I haven't seen these numbers in a while, but what we have tended to see is that actually Facebook as a social platform is really good to conservatives in terms of the most prominent voices. They get a lot of their traffic coming from the social platform. Is there any credence to the idea that there is anti-conservative bias on some of these social platforms that Zuck and company run?
I mean, gosh, Tim, we've been talking about this for years at this point, right? And I feel like it's always sort of been a perceived bias, right? I think no one's really come out and shown real hard figures to say like, hey, look, the companies are intentionally down ranking someone simply because they are conservative or simply because they are liberal. What I find very interesting is that ever since Elon Musk took over X, certainly these past 6 months, he has been the most pro, Trump owner of any CEO, of any social platform we've ever seen. And yet there have been no concerns about that, right? There's been no concerns on the other side that, hey, what about, you're suppressing left-leaning voices or you're suppressing Democrats, right? And so I just find it very interesting that for years we heard about this anti-conservative bias when there was a perceived attack. And now when we have a CEO and owner who's very blatant and openly picking a side, a political side, no one seems to have an issue with that, right? So it is a very interesting dynamic. I don't know, this narrative has sort of died down a little bit on the Facebook front, but now that Trump is back in office, I wouldn't be shocked if we start to hear this thing come up again.
Just briefly, Kurt, the representatives for Zuckerberg said that the conversation was taking place at a crucial time for U.S. innovation. I'm just curious, is there any chance that the two would have spoken about ByteDance and what Donald Trump should do about TikTok?
I mean, I'd be speculating, but it seems very logical that would be top of mind. That date, the January date for the potential ban of TikTok is just a few months away. Donald Trump talked about it on the campaign trail. We obviously know it matters a lot to Meta, right? I think if TikTok is out of the picture, Meta stands to benefit more than any other company out there. So I do have to imagine that came up. It's probably a little bit of a tricky situation because Mark Zuckerberg has to sit here and probably he can't say exactly what's maybe on his mind, right? For anti-competitive reasons. But again, the timing is such that it's hard to imagine it wouldn't have at least been brought up.
Kurt, thank you so much for following all of this so closely for us. That is Kurt Wagner, and we will be talking to him again, no doubt.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Federal officials projecting the busiest Thanksgiving travel season yet. We're still going to see some final numbers in the coming days, but check this out. In the past 2 days alone, the TSA has screened more than 4.2 million passengers. Joining us now to share with us what travel trends he's seeing as the holiday season kicks off is Clint Henderson, the Points Guy managing editor. Clint, always good to see you. Have things gone off without a hitch so far?
You know, remarkably, I was a little nervous about yesterday because we had all those storms across the country. The airlines recovered really quickly. I do feel like all the staffing moves they've made over the past couple of years are starting to pay dividends. You know, a lot of airlines have invested in technology after spectacular meltdowns. I think all that's paying dividends. The one area I'm really worried about still is air traffic control staff shortages. So that's something I'm watching closely, especially in Newark. But other than that, it's been really smooth.
Why are there shortages?
It's a job that's really hard. It's really stressful, especially in the Northeast region, the busiest part of the country. You know, you've got Newark Airport, you've got JFK, you've got LaGuardia. Imagine the number of planes coming in and out of the area. One of the reasons we've seen a little bit of an issue with ATC is because they've moved Newark control over to Philadelphia to try to ease the training issues. And so 24 ATC workers moved over to the Philly area. And, you know, it's going to take some time. It's a long-term solution to a long-term problem. This has been a problem for years. Apparently, a bunch of the people that they train end up dropping out because it's just too stressful. So that's a little bit of the backseat there.
Okay, Clint, I want to shift gears a little bit because now is the time of year where the airlines start coming out with updates to their rewards programs. Delta's certainly taken a little bit of heat for changing its rewards program around. At the end of the day, are these rewards programs actually still worth it, given what you get in as a reward and given how hard it is to achieve certain levels of status?
Mm-hmm. So you put your finger on the raging debate in the points and miles world right now. A lot of my coworkers are giving up on top tier status. You're not getting the upgrades you used to get. There's more people, it seems like, in the top tiers, and the juice is just not worth the squeeze for some people. Now, that said, I am going to keep Delta Diamond and American Airlines Executive Platinum because I'm one of the true.
That's a flex.
But I will. But that's not going to continue long term because it's gotten too expensive. So one of my colleagues on the United program is going to drop down to gold this year. It's getting harder to redeem points and miles, and you have to be more aggressive and more invested into how to maximize it to squeeze out the perks. But here's what I will say. We're still seeing a ton of deals. There's still good sign-up bonuses. There's still amazing business class redemptions you can get on programs like Air France or Air Canada Aeroplan. We do see those unicorn fares, we call them, even in the US program. So for me, that's why I'm still all in, even though I'm not getting upgraded on most of my flights these days.
What about the hotels, Clint? You know, some of the branded hotels are perhaps worth signing up to their loyalty programs for because you may eventually get a night for free. But some, you know, you really have to spend a lot of time in them. I'm thinking of Jumeirah and some of these really top tier hotels.
Yeah, and the truth is, Four Seasons, some of these other programs
don't even have loyalty programs, right?
Exactly. So that's the thing. For me,
do you like that I know that, Tim?
Yeah, I was like, how do you know that? That's pretty impressive. So, you're staying at the right hotels.
Yeah.
That's why my team focuses on Hyatt, Hilton, and IHG and Marriott, because we know we're going to get something for all those stays we're putting in. But I will say, World of Hyatt to me gets the gold crown because they really do take care of their best customers. If you get 60 nights a year, you get upgrade certificates. There's all kinds of goodies, and their points have not been devalued like some other programs have. So you can stay at a Park Hyatt anywhere in the world for 30, 40,000 points. So to me, that's a really valuable program.
Okay, so hotels, still some value out there to be found. Airlines, perhaps. My problem with these airline loyalty programs, Clint, is if you get to the next level in something, it basically oftentimes just means you can check another bag. Like, I'm not seeing the actual value here. You're not, doesn't seem like you're being treated any different. You're not getting space at the front of the plane. It's sort of like kind of a joke now.
Yeah, so it's a really big problem for the last minute business travelers, because if you're flying Delta, for example, hub to hub, you're not going to get even a main cabin extra seat, even if you have top tier status, because those seats are all sold. They're all gone. And that's just coach. That's not even to say upgrade list. I've seen upgrade lists of 50 people, 55 people. So yes, it is of truth that if you want first class these days, you have to buy first class. I will say, though, even gold level status on most of the airline programs, if you're booking a month out, you're still going to be able to get extra legroom seats, extra baggage allowance, early boarding, and a possibility of an upgrade. So for me, there's still some value to be had there. It's just getting harder and harder to maximize.
The possibility. Okay, maybe. Hey, before we let you go, Clint, I want to talk a little bit about what 2025 is looking like. It certainly seems like this year and last year were huge years for Americans traveling to and from Asia. A lot of folks, at least anecdotally, who I spoke to, a lot of colleagues making some big trips to Japan and the like. What's hot come 2025?
So you hit it. Japan is hot, remains hot. The US dollar.
Wow.
Yes, very. In fact, that's the one part of the world that I'm not seeing a lot of deals. So you're still not seeing, I'm seeing $500 sub $500 round trip coach fares to Europe regularly. I'm not seeing those same deals to Japan these days. And Australia, New Zealand, also very hot. But you want to go where the US dollar is stronger, especially if you can find a decent price ticket. I'm going back to Japan, but I'm using points and miles for my trip. So you got to be smart about these things.
Okay, so we need to know a little more detail. Which carriers?
Okay, so I used Alaska Miles to book Starlux, a new Taiwanese airline, in business class, 70,000 miles one way. And then I was able to use American Airlines miles to book Japan Airlines via American for 60,000 miles in business class. So the deals are out there. You just have to really hunt and peck, and you have to educate yourself a little bit on points and miles, but the deals are there, I promise.
I've tried to do the things that I see online on sites like yours, Clint, where it's like, okay, sign up for this plan because then you can redeem miles for this domestic carrier. And I've never had any luck doing it. It's like sign up for the international plan, do a search that way, and there's still no flights. Like, what's the secret here?
So the secret is flexible calendars, flexible dates. So if you want to travel when every other family wants to travel for spring break, you're probably not going to score. But if you can hunt and peck and find that availability, plans like Air France, Flying Blue, KLM, their program. I like the Aeroplan Air Canada program because you can usually find availability. It's just sporadic. So you just have to really hunt and peck. And the other thing is there's these new points search startups like Point.me that you can sometimes find in big sweeping searches of the calendar. You can find those dates that do have that unicorn availability. So
Clint, where are you finding those sub $500 Europe trips?
So regularly, American Airlines right now has a Black Friday sale under $500 from cities like Charlotte, from cities like New York to London for under $500 round trip. But TAP Air Portugal, some of the lesser known European.
But then it costs $800 to get from New York to Charlotte.
Well, but those flights are available from New York to London under $500 on American Airlines.
Just take the bus.
All right.
Take the bus to Charlotte.
I don't need to anymore.
Okay.
He said I just need to up my American miles.
In London, American Airlines. Yeah.
Hey, what about warm places to go as it gets cold outside? What are you seeing over the Christmas holiday? And what are you seeing in the early part of January for like President's Weekend and stuff?
Yeah. So hot tip, the places that were the hottest coming out of the pandemic. So Florida, Hawaii, Las Vegas, those are on sale now. So we're seeing more reasonable prices. And Maui, regularly, I'm seeing under $300 round trip tickets. The problem with Maui is the hotels are still pretty expensive, but there are deals to be had to places that maybe you didn't get to go to right out of the pandemic because they were just too expensive, including Miami and including places like Maui, Kauai, and Hawaii.
Clint Henderson, managing editor at The Points Guy. Next time I have a points question, I'm just going to send him an email. I got these United points. I got these United points. They feel like they're not worth anything because I can never find a flight.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jurrien Timmer is Director of Global Macro at Fidelity Management and Research. We were just saying a little bit earlier, Jurrien, that this has been quite the fall and winter for macro, global macro, and particularly US macro. There was a lot of surprises, no? And in a season where we weren't quite sure there would be that many surprises.
It sure has. And by the way, it's a pleasure to be here. But really, the last 4 years has been full of surprises, really. That we're still dealing with sort of the how to interpret market cycles in the aftermath of the pandemic, of course, and all the things that changed. 2 years ago with the inverted curve, we were all expecting that recession, and here we are with the economy remaining quite resilient, inflation, or at least the rate of inflation, getting closer to the Fed's target, although it is being more stubborn in the last few months with the core PCE now ticking higher to 2.8. But the earnings have come through, and that is the most important thing. You ask anyone at Fidelity in Boston at the mothership, it's price follows earnings, and earnings is what we are looking at. And earnings season, of course, is pretty much over. 9% growth year over year, and the growth rate for the calendar year will be around 10%, it looks like, this year. And expectations for 12 next year, that might come down a few points. But, if we are getting into an animal spirits cycle after the fairly decisive election and a new capital formation cycle begins, and the AI boom already is sort of forcing all companies to go into the CapEx mode. The hope is, of course, that we get a true productivity boom. We'll have to see if it actually happens. But if that's the case, then you can get a higher sort of speed limit for the economy, which means the economy can grow faster without inflaming the inflation rate, right? And I think that is the great hope for this market. My biggest, not a concern, but I think one of the impediments will be next year that this is not like 2017, right? When the first term of the president started, and obviously we had the tax cuts happening in 2017. That year was a very robust bull market, led by both earnings growth and valuation expansion. But rates were much lower. The Fed was barely off of zero back then. Inflation was not a story. And in 2025, that is a different landscape. And so one of the things that I look at is interest rates. The 10 years behaved. It's 4.20. It was at closer to 4.50, and it was at 5% a year ago. And so far, so good there. But occasional flare-ups in yields, I think, is likely to be not a bull market ender, but at least an interrupter.
There's this policy proposal, or a series of policy proposals from the Trump administration that we got on the campaign trail, and I'm wondering how you're factoring that into your analysis. And it's the idea that, okay, if he goes through with these tariffs that he actually announced earlier this week, what could that do to inflation here in the U.S.? And then also, what about mass deportations? And whenever I talk about this, I say, obviously, the human can, the human side of the story, putting that aside and just thinking about the economic effects of deporting millions of people over a short period of time, many of whom do work in jobs here in the U.S. So I'm wondering what you're looking at in terms of economic shocks there.
Yeah, it is a concern. And, of course, no one really knows whether the tariffs are going to be just a bat that the president carries around to try to get better deals. I mean, certainly the announcements with Mexico and then the meeting or the phone call with the Mexican president kind of give an indication that this is really to start negotiations for better trade deals. But it, of course, is a risk, because if importers have higher costs, they either need to pass those on to consumers, or it eats into their profit margins. And then it's a question of to what degree other things offset it, right? The dollar is very strong, so that would be an offset, for instance. So it remains unclear to what degree it would be inflationary. And of course, deportations would presumably be inflationary as well. And if you think about what the Fed and the economy has accomplished in the last couple of years, right, with the great rate reset in 2022, the Fed was trying to obviously slay the inflation dragon, which it has at least partially done. And it was trying to rebalance the labor market, which was in overdrive back then, right? Because the economy, when it shut down during COVID, Obviously, many people left the labor force, and then when it reopened, those people did not return right away. So there were lots of job vacancies that were unmet. Now that supply has returned, and immigration, I think, is certainly part of that. And so the labor market is in perfect balance right now. It has reset itself, not through layoffs, but through people coming back in. If you start deporting people who are working in the labor force, obviously you run the risk that you then upset that balance.
Right, exactly. So if the market is only expecting 2 to 3 interest rate cuts next year, should it really be rethinking that in the sense that the Fed should possibly get in front of some of this?
Yes, I think so. So the Fed has cut, of course, twice, by 50 and by 25. I look at various iterations of the Taylor rule, of course, the rule made famous by John Taylor back in the early 90s. And no matter how you slice it, the Fed is in the right place, having cut rates a few times. Like the Taylor rule completely supports lower rates than they were. But going forward, it is by no means clear that a lot more rate cuts are in line. And of course, when we started this year, the market was expecting 7 rate cuts just this calendar year. And then a few months ago, when we had the growth scare, it was down to a 2 handle on the terminal rate. Now, we got a 66% chance of a rate cut in December. I think the Fed can go either way. The economy obviously is not falling off a cliff waiting for another rate cut. But my sense is that the Fed was right to do what they've done so far, but I would hold some more rate cuts in reserve rather than giving them to the markets and running the risk that you then have to take them back. Because I think one of the risks sort of economically is that, inflation went from 9 to 3 in 2022 to now. If you look at the CPI, the core PCE went from 6 to 2.8. So inflation is better than it was, but it's still above 2, right? And oftentimes the pendulum has to swing all the way through to stay at 2. So if the economy now reaccelerates at a time when inflation has not yet been slayed, you run the risk that that reaccelerates, and then the Fed is in a much more difficult position.
Yeah, I don't envy the job that Jay Powell has right now for many, many reasons. Hey, just finally, switching gears a little bit, $7 trillion in cash on the sidelines right now, at least in money market funds, as of just a couple of weeks ago. Where does that cash go and when?
I've been asked that question so many times, and my sense has been, so I follow this. Fidelity is one of the big players in the money market fund industry. So the way I look at the cash on the sidelines is I look at it as a percentage of the equity market cap. And as a percentage of the market cap, it's around 10.5%, which is exactly in line with the historical average. So there's a lot of cash, but equities are worth a lot. So how much comes out and can it move the equity markets is to me the big question. But the caveat with the mountain of cash thing is, like, for instance, during COVID, money went out of the stock market into money markets, earning zero because people were panicking. And so that truly was a flight to quality trade, which was then later reversed, of course, when the market was at a high, right? It came out at the low, comes back in at new highs. So it shows you the perils of market timing. This mountain of cash came out of the banks. 2 years ago during Silicon Valley Bank and banks paying 0.5%. So there is some cash there, maybe $1 trillion, but it's not $7 trillion.
All right, Jurrien, we have to leave it there, but we got to the end of the answer. So thank you. That is Jurrien Timmer, who is Director of Global Macro at Fidelity Management and Research. Much, much appreciated.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.